There is a real Australian law about cash transactions that catches people off guard, but it is not the one going viral online right now. Forget the scary made-up fines you might have seen floating around about ordinary ATM withdrawals. The real rule is more specific, more reasonable, and honestly more important to understand correctly. Because getting it wrong in your head could lead you to either panic over nothing, or worse, actually walk into a genuine problem without realizing it. Let's clear up exactly what Australian law says about cash, ATMs, and reporting, using the actual rules rather than the rumor mill version. Welcome back to my channel, and today we are setting the record straight on one of the most misunderstood pieces of financial regulation in Australia, the rules around cash transaction reporting and something called structuring. There is a lot of fear-based content circulating right now, claiming that ordinary Australians can be hit with specific fixed penalties just for making a few ATM withdrawals in the same week. That is not how this actually works, and I want to walk you through what the law genuinely says, who it is actually aimed at, and what completely normal cash behavior looks like compared to the kind of conduct that can genuinely get someone in legal trouble. Let's start with the actual foundation of the system. The Australian Transaction Reports and Analysis Centre, generally known as AUSTRAC, is the government agency responsible for monitoring the financial system for money laundering, terrorism financing, tax evasion, and related financial crime. AUSTRAC does this largely by requiring what are called reporting entities, meaning banks, casinos, remittance providers, and similar institutions, to report certain kinds of activity. One of the central reporting obligations is the Threshold Transaction Report. If a customer deposits or withdraws $10,000 or more in physical cash in a single transaction, the bank is required
to report that transaction to AUSTRAC. This has been the law for a long time, and it is worth repeating clearly. This reporting requirement applies to the bank, not to you personally. And simply having a transaction reported does not mean you have done anything wrong. It is a routine piece of financial monitoring, not an accusation. Now, here is where the real rule that people should actually understand comes in, and it is called structuring. Structuring is when someone deliberately breaks up a large cash transaction into multiple smaller transactions specifically for the purpose of staying under that $10,000 threshold and avoiding the reporting requirement. For example, if someone has $15,000 in cash they want to deposit, and instead of depositing it in one transaction, they deliberately split it into several smaller deposits over a few days, specifically to prevent the bank from having to file that report. That is structuring, and it is a genuine criminal offense under Australia's anti-money laundering and counter-terrorism financing law. The key word in that description, and the part that so much fear-based content conveniently leaves out, is intent. The law is concerned with deliberate efforts to evade a reporting obligation, not with ordinary everyday cash habits that happen to involve more than one transaction. This distinction matters enormously because it is the difference between something that could genuinely expose someone to legal risk and something that is a complete non-issue. So let's talk about what normal, legitimate cash behavior actually looks like, because this is where a lot of unnecessary anxiety gets created. If you withdraw money from an ATM 2 or 3 times in a week to cover groceries, bills, or general household spending, that is not structuring. That is simply how you manage your money, and it has nothing to do with these reporting rules at all. If you are an older Australian who prefers using cash for day-to-day expenses rather than cards, and you make regular smaller withdrawals as part of your normal routine, that reflects a well-documented and completely ordinary generational preference for cash, not suspicious activity. If you sell something privately, like a car, and the buyer pays you in cash over a day or two, simply because that is how they accessed their own money, and you then deposit it in a way that reflects how you received it, you have not engaged in structuring, because there was no intent on your part to deliberately evade a reporting threshold. Where things can genuinely become a concern is when there is a clear, deliberate pattern designed specifically to dodge the $10,000 threshold. If someone sits down and consciously decides, I have $12,000, I will deposit $4,000 today, $4,000 tomorrow, and $4,000 the day after, purely so the bank never has to file a report, that is the kind of conduct the law is actually targeting. It is important to understand that banks and financial institutions do use automated systems to look for patterns that resemble this kind of deliberate evasion. And if a pattern looks suspicious, the bank has an obligation to file what is called a suspicious matter report. But being flagged for review is not the same thing as being fined, and a review does not automatically become a penalty. It simply means the bank is doing what it is legally required to do, which is looking closely at unusual patterns, and where necessary, asking for more context. It is also worth being clear about the actual scale of AUSTRAC penalties, because the specific fixed dollar figures that circulate online for individual ATM users generally do not reflect how this system actually operates. Penalties under Australia's anti-money laundering law are calculated using penalty units, and the value of those units is set by legislation and adjusted periodically. Civil penalties for serious, proven contraventions can be substantial, running into the tens of thousands of dollars, or significantly more in serious cases. But the vast majority of AUSTRAC's actual enforcement activity is directed at reporting entities themselves, meaning banks, casinos, and other financial institutions for systemic compliance failures, not at everyday individuals for making a few withdrawals in the same week. So what should you actually take away from all of this? First, if you are conducting a normal cash transaction, whether that is a private sale, a series of ATM withdrawals for personal spending, or business takings, and there is no intent to evade a reporting requirement, you are not doing anything wrong, and you do not need to change your ordinary financial habits out of fear. Second, if you do find yourself needing to move a genuinely large amount of cash, whether from a sale, an inheritance, or a large purchase, the cleanest approach is simply to be transparent about it. Keeping a basic record, such as the amount, the date, and the reason for the transaction, is good practice regardless of the amount involved, and it gives you something concrete to point to if a bank or AUSTRAC ever asks a follow-up question. Third, if your bank does contact you about a transaction pattern, that is not automatically a penalty notice. It is typically a request for information, and you are entitled to explain the legitimate reason behind your activity. The broader lesson here is one about how to evaluate financial information in general. Real regulatory changes do happen, and staying informed matters, but the accurate version of a rule is usually far less dramatic and far more reasonable than the version that spreads quickly online. Structuring laws exist to catch deliberate, intentional efforts to hide large cash movements from oversight, not to punish pensioners for visiting the ATM a few times a week or private sellers for accepting cash for a car. Before you let a headline or a video, it is worth taking a moment to check the claim against the actual source, whether that is AUSTRAC's own published guidance or a qualified financial or legal professional, rather than accepting a specific dollar figure simply because it sounds alarming and gets repeated often enough. The bottom line is this: Australia's cash reporting rules are real. Structuring is a genuine offense, but it requires a deliberate intent to dodge a reporting threshold, not ordinary cash habits shared by millions of everyday Australians. If something you have seen online about a fixed fine for normal ATM use made you anxious, take a breath, because that specific claim does not reflect how this system actually works. If this video helped you separate fact from fear on this topic, give it a like, share it with anyone who might have seen the same misleading claims, and subscribe so you get accurate breakdowns like this one whenever a new financial rule actually changes. Thanks for watching, and I will see you in the next